In accounting, capital refers to the financial resources or assets that are invested in a business by its owners or shareholders. It represents the initial contributions and subsequent investments made by the owners to start and operate the business. Capital is a critical component of the balance sheet. One of the financial statements that provide an overview of a company's financial position at a specific point in time. There are two main types of capital in accounting. 1. Shareholders, owners, capital. This represents the contributions made by the owners or shareholders of the company. It is also referred to as equity capital. Shareholders' capital is typically recorded in the owner's equity section of the balance sheet. It can be further categorized into A. Paid-up capital. The amount of capital that shareholders have contributed to the company by purchasing shares. For example, if a company issues 10,000 shares at $10 per share, and all the shares are purchased, the paid-up capital would be $100,000, 10,000 shares x $10 per share. B. Additional paid-up capital, capital surplus. This includes any additional amounts received from shareholders over and above the face value of the shares. If the company sells shares at a premium, higher than the face value, the excess amount is recorded as additional paid-up capital. C. Retained earnings. This represents the portion of the company's profits that are retained within the business rather than distributed to shareholders as dividends. Retained earnings are accumulated over time and contribute to the overall capital of the company. 2. Borrowed capital, debt capital. This refers to funds raised by the company through loans, bonds, or other forms of debt. Borrowed capital comes with an obligation to repay the principal amount along with interest. It is typically recorded under the liabilities section of the balance sheet. For example, if a company takes out a bank loan of $50,000, the borrowed capital will increase by that amount, and the corresponding liability will also be recorded on the balance sheet until the loan is repaid. Example: let's consider a hypothetical company called XYZ Inc. The owner of XYZ Inc. invests $100,000 in cash to start the business. Additionally, the company issues 10,000 shares at $10 each, and all shares are purchased. The company also borrows $50,000 from a bank to finance its operations. 1. Shareholders, owners, capital. Paid-up capital, $100,000, initial investment by the owner, additional paid-up capital. $0, assuming shares were issued at face value, retained earnings. $0, assuming the company has not earned profits yet. The total shareholders' capital will be $100,000. 2. Borrowed capital, bank loan. $50,000. The total borrowed capital will be $50,000. Therefore, the total capital for XYZ Inc. will be the sum of shareholders' capital and borrowed capital, which is $100,000, shareholders' capital, plus $50,000, borrowed capital, equals $150,000. In summary, capital in accounting represents the financial resources provided by the owners and creditors of a business to fund its operations and is a fundamental element in determining the financial health and stability of the company.